Is the Consumer Financial Protection Bureau too independent? I'm Adam Byrne, and this is Scholar's Mate. Hello and welcome to Scholar's Mate. I'm your host, Adam Byrne. The Consumer Financial Protection Bureau was created by the Dodd-Frank Financial Reform Bill, which President Obama signed in 2011 in the wake of the 2008 financial crisis. The brainchild of Senator Elizabeth Warren, the CFPB aims to protect consumers from abusive practices of financial institutions such as banks and credit card companies. But since its inception, critics have argued that the Bureau lacks proper oversight and accountability, although its defenders say that its independence is a feature, not a bug. So, is the CFPB too independent? Joining us to discuss the issue is Christopher Peterson, Director of Financial Services and Senior Fellow at the Consumer Federation of America, and a Professor of Law at the University of Utah. He previously served in the Office of the Director at the CFPB and as Senior Counsel for Enforcement Policy and Strategy in the CFPB's Office of Enforcement. His books include Consumer Law, Cases and Materials, and Taming the Sharks, Towards a Cure for the High-Cost Credit Market. And also joining us is Ronald L. Rubin, a lawyer and writer in Washington, D.C. He has been a criminal prosecutor, enforcement attorney at both the CFPB and the Securities and Exchange Commission, law firm partner and chief advisor on regulatory policy at the House Financial Services Committee. His influential National Review article, The Tragic Downfall of the Consumer Financial Protection Bureau, was cited by a federal appeals court judge in a recent case that challenged the CFPB's constitutionality. So, gentlemen, thank you both for joining us.
Thanks for having us.
Thanks for inviting me.
So, Ronald Rubin, why do you think the CFPB is too independent?
Well, before I get into my argument on that, I just want so viewers understand to explain what we mean by independent or what makes the CFPB independent. Essentially, there are two features of the CFPB structure. The first is that rather than being led by a commission, it's led by a single director who serves a 5-year term who cannot be fired except for cause. And secondly, that the funding of the agency, as opposed to coming through Congress, is actually guaranteed through the Federal Reserve Bank, which has its own profits. So Congress has no say in the budget. And those are really the two main features that when we say independent, meaning that there's very little that either the President or Congress can do to control what the director of the CFPB and the agency does. So basically, the first important question is, when you say independent, you mean independent from what? The argument from the left and for this structure is that politicians are too susceptible to basically being influenced by the banks and money from the banks and the financial services industry, so that they simply cannot, avoid being bribed is the way you want to put it. And so therefore, you have to take the agency completely out of the political process. But really, when you say you're going to make it independent, the agency independent from the president and from Congress, what you're saying is you're making it independent from voters. You're basically making it independent from democracy. And that is not a good thing. And basically, what you saw here at the CFPB was you created an unelected official who essentially had absolute power.
Okay, and Christopher Peterson, how do you respond to that argument?
Well, again, thanks for having me. It's a pleasure to be here and to have a good debate about this. I guess I'd ask the viewers to think back 10 years ago to the financial crisis when many of America's banks collapsed because they couldn't pay their debts, and millions of Americans, nearly 10 million Americans, depending on different estimates, were forced out of their homes through foreclosure or short sales. And that has had serious repercussions all across America. And I think that it's not just home mortgage loans, but credit cards and other financial products and payment systems have systemically in our country had reoccurring problems where there are tricks or traps or deceptive features, misleading features that lead ordinary working families into problems where they can't control their own financial lives and their own financial destinies. And I think that the CFPB was created to have an independent watchdog to try to make sure that our banks and credit unions and other financial companies are treating their customers fairly, that our products are transparent, that we can understand them, and that we can shop effectively in the marketplace to get the best deal for each of us. And in particular, I'd point to some of the enforcement cases that the CFPB brought. You know, the CFPB over the past few years has succeeded in returning over $12 billion in restitution, refunds, and forgiven debts to consumers. And 90% of those refunds came in cases where the financial institution said something that was untrue to their customers, something that was deceptive or misleading.
So it sounds like the argument then is, if it's not broke, don't fix it.
Well, it is broke, and it's been broke almost from day one. And so we start, for example, with Chris using the number $12 billion. Well, you know, as a good analogy, they executed a lot of witches in Salem, you know, but that doesn't mean that they were actually stopping witchcraft. So at the CFPB, you have basically the CFPB writes the rules with a very subjective law, unfair, deceptive, and abusive acts and practices, which the CFPB is allowed to define all those terms, and then they judge them, and then they convict them. And so the fact that you got a lot of judgments against companies doesn't mean that the companies did wrong. But what's even more kind of indicative of what's so wrong with the CFPB is that $12 billion is the most false number that has ever been written. So first of all, big parts of that were civil money penalties. The parts of that were supposedly restitution that supposedly went back to consumers, a lot of it was loan forgiveness, other things, but it was far, far less than $12 billion. And the civil money penalties, which supposedly went back to other harmed consumers that the CFPB were able to locate, well, it turns out that lots and lots of that went to Democratic organizations, slush funds. And because the CFPB could not be audited and Congress had no way of actually getting them to provide the information of where that money was going, that when Congress asked, well, where's the money going, basically Richard Cordray was the director at the time, just said, sorry, I'm not going to tell you.
So there's some disagreement on how effective the CFPB has been, but on your point, you summarized the structure of the agency well. Do you disagree with the fact that perhaps the director of the CFPB has too much power?
So a lot in that it's hard for me to pass up and not respond to. So if I could, just briefly, note the $12 billion number comes from a study that I did myself that was published in the Minnesota Law Review, and I read every case and did the detailed work to guarantee that was actually the correct number. That's separate from the fines that Mr. Rubin, that Ron is talking about. But with respect to the structure in your question, I think that there are a lot of administrative agencies that are run by a single director, the State Department, the Defense Department, and there are also some independent agencies that have a bit of separation from the president that have functioned well for a long time. The Federal Trade Commission, the Federal Reserve Board of Governors, the Office of the Comptroller of the Currency, it's an esoteric name, but that's the agency that has been primarily responsible for ensuring the safety and soundness of our national banks. It's an independent banking agency that is funded not by Congress, but by fees and revenue that are collected from banks, and is headed up by a single director. So it's not that unusual in government. And my view is that it's not that we want independence from voters or from the public. The problem in Washington is not that voters are getting too much say. The problem is that lobbyists are getting too much say. And it's important for us to have some agency in the federal government that's separated out with some limited firewalls so it can focus on protecting consumers and be above and aside from the political fray of the day, the political conflict, and have some immunity from the ordinary, using the president's term, the swamp in D.C.
Well, so first of all, your claim, which is made frequently over and over again, is that there are many agencies like this. That is absolutely false. The only agency that has the ability to really levy those kind of fines and have that much effect on the economy is the Securities and Exchange Commission, where I worked. And second of all, I'm glad you mentioned your study, Chris, because I again go back to my point that if companies are not being having due process and they're simply being extorted and being forced to pay money, then for you to then go and I always imagine you doing color coding and putting little tabs on them, but that is literally the definition of putting lipstick on a pig, because the underlying data that you were talking about were completely falsified information.
Okay, so I have to respond. I mean, look, these cases, every one of these cases, these are banks and financial companies that have deep pockets and are fully capable of defending themselves in court. And most of these cases were settlements where the company agreed that they were going to settle this lawsuit and not fight. But then many of the cases, they did go to court, and overwhelmingly, of the 200 or so CFPB cases that have been brought, the overwhelming majority have been won by the CFPB.
Okay, so just to get more again to the independence of the CFPB, you might disagree that this is the structure is common across government. You say maybe it's quite rare, but the people who set up the CFPB and Elizabeth Warren, that's not an accident, no. So it was by design. So isn't that part of the feature of the CFPB, that they're somewhat, as Christopher was saying, independent from quote unquote the swamp?
Well, Congress passes laws that the Supreme Court later finds unconstitutional all the time. So the fact that Congress actually, by the way, a veto or a filibuster-proof, more or less, Senate and a overwhelmingly Democratic Congress passed something with a Democratic president is not an evidence of anything other than the fact that they had all of the control at that time. And to Chris's point about companies having money so that they could defend themselves, in fact, I represented, when I was in private practice, many companies who were absolutely not guilty. And they went in and they looked and they said, well, for example, unfair, deceptive, and abusive acts and practices. The CFPB it's up to them to define what it means. We literally cannot defend ourselves. And on top of that, the PHH case, which was a great example, was a administrative law judge who assigned a $6 million fine, and internally, before you get out to the courts, to the federal courts, you have to appeal it to the director, Richard Cordray. So what did Richard Cordray do? He said, not only do you owe $6 million, but you owe $109 million. So any company that basically folded, they folded because they didn't have a chance in the first place. And the other thing is that companies, even if they have the money to try to put up a fight, there's terrible publicity that comes along with it. And the CFPB had almost its primary goal was publicity. And so these companies knew that if they had any kind of a public fight with the CFPB, that they were going to get slaughtered in the press. And so they literally said, we have to just fold and pay, we consider this basically a cost of doing business, that we have to pay off this agency that has the ability to make us pay anything at all that it wants. And as to finding the facts, basically what I saw in almost every CFPB investigation was that the CFPB decided that the company was guilty beforehand, and then they did an investigation to try to basically back up the decision that they had made before they even started. So I am telling you, I was horrified, having been for 7 years an SEC enforcement attorney, that there was an agency with enforcement attorneys, by the way, many of whom I trained, who were actually willing to go in and convict what they knew were innocent companies. It was really shocking.
I'm assuming you're going to disagree with that characterization.
I just could not disagree more strenuously. I don't know what experiences that you think that you had, but we overlapped at the Bureau. We both worked there. We overlapped for about a couple weeks before you departed the Bureau. And I stayed on for another 4.5, 5 years almost. And what I saw at the CFPB, day in and day out, were dedicated civil servants that wanted to promote justice in the country, that were working hard to try to be fair to everyone, that were following the facts and calling balls and strikes in terms of protecting the public interest. And I just think that the claims that you're making, that virtually every case that there was trying to convict innocent companies, honestly, I respectfully, I feel like that's an outrage and an insult to these public servants that have dedicated their lives to trying to protect civil society in America.
Well, so it's hard to kind of dispute a broad statement like you make, but I'll give you one case that's a great example. And I mentioned it before, Ally Financial. So the one thing that the CFPB was forbidden from doing from the Dodd-Frank Act was regulating auto dealer lending. So that was the one thing that they had to try to do. So what did they do? They said, well, we don't have any data at all on the races of car dealers, clients who were taking out loans from car dealers. So we're going to just basically guess them from their zip codes and their last names. And just to start out with, to say that there was discrimination in the first place. But since they couldn't go after the car dealers directly, what they did was they said, we're going to go after basically the finance companies that buy car loans in the auto market. So car loans with higher interest rates are more valuable. And so these companies were buying these loans for market price, basically. And the CFPB went after them. Basically, this was their argument. Because you pay market price and because you incentivize companies, car dealers, to get the highest interest rate they can negotiate from their customers, therefore you are enabling discrimination, because if some people may be getting higher rates, paying higher rates, minorities may be paying higher rates.
So I know you're itching to get back in, but if you're given one particular case, maybe we could look at another case of Wells Fargo, created thousands of just accounts for people without their permission, and the CFPB ended up hitting them with a massive fine. So isn't that a case where the Bureau is working exactly as it was intended to?
Sure. No, absolutely not. Nothing could be further from the truth. The fraud was uncovered by the Los Angeles city attorney. It was investigated by the city attorney and the comptroller of the currency. And at the last minute, the CFPB, without really doing an adequate investigation at all, came in and said, okay, because we have the ability to charge a larger fine, we're going to charge the biggest fine, and we're going to make everybody think that we actually did this investigation. What happened in the year afterwards, in the couple of years afterwards since? Mick Mulvaney's CFPB, under
the
Mick
acting
Mulvaney,
director,
yes, under Republicans, they went in again and they did the real investigation, and they found so many things wrong that the CFPB should have found if they had actually done a real investigation, that they fined them $1 billion. $1 billion. So the CFPB completely dropped the ball on that investigation.
I feel like your position doesn't make a lot of sense here. I mean, Wells Fargo has been a troubled bank for a long time, and there have been multiple product lines that they've had where they've gotten into trouble. And on the one hand, you're attacking the CFPB for not doing enough, but then, once the political tides change and there's another case that comes into town and there's a larger fine that's imposed in another very serious case, then all of a sudden it's okay. So I'm not really following that. I do want to go, if I could, if it's my turn, if I could, I'd like to go back to the car loan discrimination case, because I think it's a great example of a place where the CFPB actually was doing a good job. So what happens when you go to a car dealership to apply for a car loan? It could be that you come in with, to purchase a car. It could be you come in with cash. It could be that you try and get that car dealership to help you find financing. And many car dealers will go out and arrange credit for you. But what many Americans don't understand is that when the car dealership goes out and finds a loan for you, you may have a whole choice of different interest rates that the car dealership may not be presenting to you. So that lender might be offering you, say, a 5% interest rate given your income and credit score and background and the type of car. But they may also offer a side kickback to the car dealership to convince you to take on a higher interest rate loan. Now, that by itself, so far, courts have not said is illegal. But what is illegal is if that lender is doing it in a way that is discriminatory, because what the CFPB studies found was that on a systemic basis, African Americans and Latinos were paying higher interest rates than they qualified for at a disproportionate rate in relation to white Americans like me. The CFPB said no, we weren't going to tolerate it, and ultimately they settled those lawsuits. The banks agreed that they were going to change some of their practices, temper some of the problems that they were having, and provide some compensation back to their customers for engaging in illegal discrimination that violated our civil rights laws. That is a success story for America, as is the successful prosecution of Wells Fargo for creating fake bank accounts for hundreds of thousands of people that were simply identity theft and fraud.
Again, the CFPB did not ever prove discrimination, and in fact, when they sent out checks to people for the supposed discrimination, because at least 30% of the people who were discriminated against were actually white. So, in other words, they were guessing at people's races.
Now we're going to take some questions from our viewers, and we'll start with Austin Stanley, who asks, isn't power without checks and balances a recipe for tyranny?
Well, there are checks and balances. So first off, the director of the CFPB has to go to Congress every multiple times a year and testify. And if Congress decides to change the way that the CFPB is funded, then it can. Currently, the law says that a portion of funds that funds the Federal Reserve Board of Governors, which operates a lot of the critical banking infrastructure, some of those funds are dedicated to going to consumer protection right now. But Congress can change that law anytime it wants. In fact, that's what I think some people have been advocating. But so far, I just don't think that's a good idea. There are checks and balances. The president can exercise some control. And of course, every defendant in every case that the CFPB has ever brought has the right to go to court and have an independent judge evaluate their claims. Those are all the kinds of checks and balances that have kept the CFPB, going forward in a positive way, providing the kind of services and protections that Americans deserve and expect.
So there's plenty of checks and balances for the Bureau?
There's no checks and balances. It's absurd. I mean, what you basically said was the check and balances that Congress can change the law. So, well, right. Okay, I agree. Congress should change the law, but we all know how
they can.
But because it's in its current state, there are no checks and balances. There are no checks and balances on this agency, and well, first of all, you have to go all the way through the internal processes, and then you have the Chevron doctrine, which hopefully will be overturned at some time soon, which says that the courts have to basically defer to whatever the agency wants, the way the agency interprets laws. And so for something like unfair, deceptive, and abusive acts and practices, the agency can basically say whatever they want to say.
I think that your position doesn't make sense to me. On the one hand, you say that they're losing in court, but that there's no check or balance. That's not a consistent position, Mr. Rubin. If they lose in court, that means that judges can decide against the Bureau, and in fact have done so on occasion, when the CFPB maybe got it wrong or when a judge disagreed with their evaluation of the law. And of course, Congress can pass laws changing the CFPB. That's a check and that's a balance, but it doesn't mean that they should. Why? Because we need that independent watchdog looking out for ordinary Americans.
Can I answer, since he said that my position is illogical? The vast majority of the CFPB cases were settled because they knew that they had no chance in court. So there have been a few.
Because they were going to lose.
No, because the process was completely. When the CFPB can say, we think this is abusive and we'll tell you what abusive means, and there is no court that can possibly overturn that. So the fact, when I was a criminal prosecutor, Chris, when I began, at the beginning of my career, I always thought, well, I'm going to win in every case because generally speaking, most people who are arrested are guilty, and so I'm going to win. But in fact, the cases that I ended up trying were the toughest cases because the defendants settled the cases when they knew they couldn't win. In the CFPB's case, the defendants knew they couldn't win because it was not due process. There was no real way of them defending themselves.
Okay, so maybe we'll move to our second question, which comes from Olive Hughes, who asks, is there a way to provide oversight for the CFPB that doesn't involve conflicts of interest? So if you're criticizing the structure, maybe you should answer Olive's point first.
Well, one of the things that I think people miss, and I got this from working for many years at the SEC, when people talk about making it a commission where there are two commissioners from one party and three in the chairman from the other, or three altogether from the other. One of the things that does is it brings great transparency to the agency. You can't, for example, hide the false data that the CFPB was using on the car lending or on where they were sending the civil money penalties. You can't do that when you have two commissioners from the other party sitting inside the House.
But let's move on to our next segment, which is Answer This, where each guest asks a question directly to the other. So who would like to go first?
I'll let you go ahead, because I'm a gentleman.
Well, I guess my question is this. What do you think that the government should do to try to stop deceptive practices in the marketplace?
I think that, and by the way, and I say this in my article, The Tragic Downfall of the Consumer Financial Protection Bureau, I believed in law enforcement and I believed in that agency. I gave up, as a New Yorker, I think people will understand this, I gave up a rent stabilized apartment with a view of Central Park to come and help build this agency. So I think having a law enforcement agency that actually professionally follows the evidence and prosecutes when they find evidence and doesn't when they don't, I think that that is a great, if it's done properly and professionally, I think that this agency can actually be a good agency.
Okay. And what's your question for Christopher Peterson?
Why would it be so horrible for there to be a commission? What would be the downside?
Well, I think that the commission-based agencies have not been as successful in moving assertively and aggressively to try to accomplish the mission of the agency. I don't think that it would be the end of the world if the CFPB were reformed into a commission, but I do think that it would probably make the agency less effective.
So now it's time for We Agree, where each guest names something that the other said that he agrees with. So who would like to start there?
I guess I'll take that first. I mean, I'm pleased to hear that, Ron, that you agree that we need to have law enforcement in the country and that we need to stop deceptive practices in the marketplace. When a financial institution says something that's not true, engages in some sort of misleading activity that leads our consumers, our public, astray, that we need to have a professional law enforcement agency that responds to it.
Okay.
This might be a little bit narrow, but I actually happen to agree with you, Chris, that as far as car loans go, that car loans are of a kind of unique nature that people go in when they go to buy a car and they just assume that the price of the car is negotiable, and they don't realize that the price of the loan is negotiable. And so rather than make up false claims about discrimination and try to take over the lending market, I just think a simple sign on the wall that said, this may not be the best rate that you're going to get. You might want to go check with your local bank, I think would be a good thing. So in general, I think a lot of the problems can be solved by simple education methods instead of basically doing what the CFPB did in that case, for example.
All right, and that is all we have time for. We'd like to thank Christopher Peterson of the Consumer Federation of America and attorney and writer Ronald Rubin for joining us to discuss this issue. And thank you for watching Scholars Mate. I'm Adam Byrne. We'll see you next time.